Welcome to Financial Statements. This video will be comparably short and sweet. Please note that this video's example is a continuation from that of the previous two videos. If you haven't already, I'd recommend at least watching the previous one. With no further ado, let's get into it. At the end of every period, businesses will prepare a reporting package for their external parties. This reporting package merely communicates the results of the company's endeavors for the period. Our reporting package will consist of the following four financial statements prepared in the following order. First, we have our income statement. As the name suggests, the income statement calculates a company's net income or net loss. You may hear this statement also called the statement of profit and loss or the P&L. Next, we have the statement of owner's equity if our company is a sole proprietorship. If our company is a partnership, we'll prepare a statement of partnership equity. If it's a corporation, we'll make a statement of retained earnings. For these lectures, our business is presumed to be a proprietorship. I'll cover the nuances of partnerships and corporations in a future lecture. Whichever of these three statements is prepared, their functions are identical: to show and explain how owner's equity changed over the period. After our statement of owner's equity, we build the company's balance sheet. This statement is sometimes referred to as the statement of financial position. When you see it, you'll hopefully notice that the balance sheet restates our accounting equation. We'll list all of our asset and liability accounts with their respective balances, along with the sum of all our equity accounts. After we total up those balances, the sum of the assets should reconcile to the sum of our liabilities plus our owner's equity. Lastly, we have the statement of cash flows, which shows from where our business received its cash, as well as how the cash was used. Don't worry about the statement of cash flows for now. This statement will be the topic of its own lecture. Let's return to our coats and arms example from the previous lecture. Recall that when we left off, we had listed all of our accounts with their respective balances, and we verified that the total of our asset account balances matched the sum of our liabilities and equity account balances. In practice, you'll probably see those balances presented in a trial balance, similar to the one on screen. A trial balance lists all the accounts with their respective debit or credit balances. Again, because each journal entry contained equal sums of debits and credits, the debits and credits of the trial balance must always equal each other. A few items to note. The trial balance will always list accounts in the following order. First, it'll list all the company's asset accounts. Then its liability accounts, and finally, its equity accounts. With equity accounts, owner's capital and owner's drawings will always be listed first, followed by your revenues and then your expense accounts. I'd also like to direct your attention to the account numbers in the far left column. Accounts will be listed in numerical order with the number indicating the account's type. For instance, all assets have account numbers in the 100s. Liabilities have account numbers in the 200s. Our revenues have account numbers in the 400s, and so forth. If you're ever stumped as to whether a particular account is an asset, liability, or equity, look at its account number. For instance, consider an account named Unearned Revenue with an account number of 205. That name may be unfamiliar to you, but account number 205 tells us that it belongs with liabilities. First, we build our income statement. The income statement is easy. We proceed back to our trial balance and look up our revenues and our expenses. We list our revenues of $14,500, our expenses, and sum them up. Then take the difference. The difference is our net income. What you're seeing here is a single-step income statement, meaning we found net income by taking the difference between the total of our revenues and our expense accounts. Note that in this instance, we only had one revenue account. If we had any others, say sales of merchandise for $2,000, we would subtotal them just as we did our expenses. When we start talking about retailers who buy and resell finished products, I'll show you a multi-step income statement. For now, you may utilize the single-step format. Next comes our statement of owner's equity. To begin, we look back at our owner's capital ledger. Since this year was Coats & Arms' first year of operations, its beginning balance was zero. That'll be our beginning owner's capital on the statement. We booked two credits to owner's capital for a cash and automobile contribution. So these two amounts sum to our contributions on the statement. Next, we add in our net income from the income statement. Lastly, we take the balance from owner's drawings. Remember that credits represent increases in equity. Since owner's drawings has a debit balance, it represents a decrease, so it will be a deduction on the statement. We sum up our net increase or decrease, add that amount to our beginning owner's capital, and we have our ending amount. Before I proceed, I'd like to emphasize how the owner's capital ledger is applied to this statement. Let's imagine that next year his business earned $80,000 in net income, and he withdrew $45,000 for personal use. His $109,200 ending balance in Y5 will become the beginning balance in Y6. If he contributed $10,000 in cash to the company during Y6, we'll put those amounts in the statement as follows. Again, our beginning credit balance will go on the beginning owner's capital line. And the credit we booked from his contribution will go on the contributions line. After that, we plug and chug the remaining amounts. My point being is that the balance in the owner's capital account does not necessarily represent contributions. That was only the case in the first year because beginning owner's capital was zero. Be sure you break up owner's capital into its component pieces when building this statement. Finally, we have our balance sheet, which restates our accounting equation. To start, we list our assets. We look over at the trial balance, identify our asset accounts, and pull them over. Now, when we list our assets, we'll group them accordingly. First, we list our current assets. Current assets are those that will convert to cash or otherwise be used or consumed within a year. The most current asset a company has will always be its cash. Receivables comprise assets that will turn into cash within a year. And your prepaids and supplies are those that will be used within a year. Next, we list our non-current assets, or those that will last for a year or more. For Coats & Arms, we only have one group of non-current assets, plant, property, and equipment, namely land, buildings, equipment, and automobiles. You may hear of non-current assets being referred to as long-term assets, but be assured that they are one and the same. We then sum up our current and non-current assets, then sum those together to get our total assets. Then comes our liabilities. As we did with our assets, we'll subdivide our liabilities into current and non-current. As with assets, current versus non-current liabilities hinge on a one-year cutoff point. Current liabilities are those that will be repaid within a year, and non-current or long-term liabilities will be satisfied beyond 1 year. In our current section, we list our accounts payable, the amounts we owe from our credit purchases. When we bought our land and our building, we did so with a loan, a note payable, which will most likely be repaid over a number of years. Now we can sum up our total liabilities. Note that if we had multiple current and long-term liabilities, we would subtotal them as we did our current and non-current assets, then sum those subtotals. Next, we build our owner's equity section. All we need here, in this example at least, is our owner's capital account. Now, we don't use the amount from our trial balance. Rather, we pull the ending year balance from the statement of owner's equity. We use this amount because it's a quick and easy way to summarize all of our equity accounts. Remember that equity consists of owner's capital, owner's drawing, revenues, and expenses. That $101,000 is just the owner's capital account. The $109,200 balance contains owner's capital, revenues and expenses, which are totaled in the net income amount, and drawings. So all of our equity accounts are summarized in that single amount. Finally, we add our total liabilities to owner's equity. Here's how a balance sheet will often be presented. Observe how it sort of mimics the accounting equation. You have assets on the left and liabilities and owner's equity on the right. At the very bottom, you see how their respective totals match one another. Sometimes you may see a balance sheet presented as shown here, with all the accounts and their balances listed in a vertical manner. The format is different, but the end result is the same. Note how the subtotals and totals are placed to the right. For instance, the subtotal of current assets is placed to the bottom right of the numbers that it sums, as does total PP&E and total liabilities. Those subtotals are combined to yield our total assets and liabilities plus equity, which are placed one more column to the right. That concludes this lecture. My next video will cover adjusting entries, so please come back for that. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your classmates and even your instructors. I'd like my videos to help as many students as possible, and I wouldn't mind getting some feedback from contemporaries. Thank you once again, and I'll see you in the next one.